Okay. Well, first of all, thank you everybody for being here today. I really appreciate your time because I know it's valuable for all of us. And before we get started, I'll switch to one slide because my compliance department requires that we put that up there. I don't expect you to read it, but at the end of the day, we need to put it up there. So I'll tell you a little bit about me. I've been a financial advisor now for almost 20 years. Prior to that, I spent 20 years in corporate America with mostly technology companies, Lucent, Motorola, Sony. So I play in that space in my practice as well. And I've also been a chamber member for, I guess, going on about 17 years now. I'm an ambassador to the chamber. I've served on many of the committees and certainly take advantage of what's going on at the chamber and these as well, because it certainly looks like this is going to be the future, right? So with that, obviously we're trying to stay calm, right? Not easy to stay calm with today's market headlines, right? You have the COVID issue, you have unemployment at 30 million people, so you got, depression level unemployment. The market was down in March up to 35%. There's been food shortages, at least in my world. It snowed on May 9th. And probably the single most important thing was no toilet paper. Enough to make anybody crazy, right? So how do you stay cool and calm and stay in the market and not make yourself too crazy? The first thing is to try and understand the markets themselves, right? So the first thing is to understand the markets. And I won't spend too much time killing you guys with some of these slides. There's some good information here. Certainly, if anybody wants any additional information, I'm happy to get it for them. But the first principle is understanding the market, right? So the first thing you need to know is back in March, the market dropped. The Dow Jones dropped 37% and the S&P 500 dropped about 35%. Market declines are normal and usually they'll present terrific buying opportunities. So if you look at this particular chart, obviously the bars represent what the market actually did in those particular years, right? So we have a 40-year time frame here, and you'll notice certainly there are more bars up than there are down. I did the math for you, so there was 30 up years, 9 down years, and then in 2011 you'll see it was a 0, so it was flat. So basically 75% of the time, give or take, and I have another slide that depicts this a little better, the markets are positive. All right, and then the blue dots represent the swing between the high and the low in that given year. So once again, you look at 08 and 09, you can see where the down was down 38%. It was high as 49% at one point down. And obviously we had a big swing back in that direction. So really the whole idea, right, everybody's heard the term, buy low, sell high, right? And that's the idea. So certainly, when you look at what's going on in the markets today, it would be tough to say, I want to sell right now, okay? So what do you need to do? You need to take a deep breath, because the second part of the market is the volatility, right? You saw some of that on the last page. And if I go back to March 9th, if you want to look there on the right-hand side of the screen, that was when the market hit its low, down almost 54%, 53.8. That was tough for a lot of people to swallow. But there was an investor by the name of Bill Miller, and I don't expect a lot of you people to know him, but he's pretty famous. He ran a Legg Mason mutual fund, and his claim to fame was he managed to beat the market for 15 straight years. It's a pretty tough thing to do for any financial guy, but he managed to do it for 15 years in a row. And Bill said in an interview very recently on CNBC that this is one of the 5 best buying opportunities that he's seen in his lifetime. And what he meant by that was, if you go back to 1973 and 74, when we had the oil crisis and Nixon resigned, the market was down 48%. 1982 was another one. We had a Mexico default, market down 28%. Some people may have heard of Black Monday in 1987. The market dropped 22.6% in one day. And then, of course, we had the 08 and 09 financial crisis where the market was down to 53.8% that you're looking at. And just as a point of information, from March 9th of 2009 to March 9th of 2020, the market has been up 359%. So if you had left your money alone, certainly you would have gotten it back and then some. So again, this is the whole reason for, trying to stay calm when you see market dips, because we use the term climbs a wall of worry, and you can see how this has several dips along the way, but continue to go up. So, it's best to try and stay invested in the market as long as you can. You need to swallow hard, but you can do it. One other point of information for those people who have been around a little while, or the ones that are involved in Women in Business, I actually presented at a Women in Business event on March 6th of 2009, right? 3 days before the market hit its absolute low. And we did do a presentation on the stock market, which was pretty interesting. Some of the comments were very funny that we got based on what was going on at the time. But that's back when they let the average Joe like myself present at Women in Business. Things have changed dramatically since then. But, don't miss that event either, regardless of whether you're male or female. It's a great event, and you should hang in there. So again, staying calm is not easy, but you need to take a long-term view when you're looking at things. And I was saying earlier, to give you some stats, if you look at this here, it's a pretty simple chart. You're looking at 1-year returns, 5-year returns, 10-year returns, and 20-year returns. And what they mean by that is they're saying, so from 2000 to 2010, then 2001 to 2011, those are 10-year rolling periods. That's what this represents. So you can see for 1-year periods, the market will usually give you 74% of the time will give you a positive return. If you wait 5 years, obviously it goes up to 82, and then obviously the numbers are self-explanatory. So when you sit down with someone to try and do a financial plan, basically you want to know what their risk tolerance is, meaning how much pain are they willing to suffer looking at their portfolio, i.e. 53.8% is pretty tough nut to swallow. But if you hung in there, you did okay when the market did do its bounce back. So the longer your time horizon, the better. So obviously, younger people have a long time horizon. Obviously, they have time to make up the highs and lows of the market. Somebody like myself, who's closer to the end of the curve, obviously, your window's shorter, so you want to be a little bit more conservative. One of the things I didn't mention early on, if anybody does have any questions as we're going along, please feel free to throw them in the chat feature, and Kay will let me know, and we'll certainly try and address those. The next key component to trying to stay calm and cool and stay invested is how compounding works. And I wasn't going to spend a ton of time on this chart because I did want to spend some on some of the other ones. This is a hypothetical. If you made a $1,000 investment, and obviously we're showing returns of 3, 6, and 10%. I could go through each one separately, but I think we'll kind of just throw them all up there because it makes the most sense. And you can see the difference in the returns based on whether you're getting 3, 6, or 10%. So the key here really is when you're investing, you have investments that pay dividends, you have investments that pay capital gains. You want to constantly reinvest those dollars because the compounding effect usually is what drives a bunch of your returns. So the investments can grow on themselves. If you use a dividend paying stock, let's say it pays $2 a year and you constantly continue to, or $2 per share, you continue to reinvest that, which you buy more shares with, which produces more dividends. So regardless of what the market does, these investments will actually grow on themselves. Now, right this minute, one of the things we need to be careful of is with the current pandemic, some companies have cut dividends, maybe eliminated them altogether. So those are areas that you want to look at when you're making an investment. You don't necessarily want to just pick anything. You want to pick established companies that are going to give you a decent return and are confident that they'll be able to continue to pay those dividends or produce capital gains or gains in general so that your portfolio will do okay. It's sort of like a snowball when you're making a snowman, right? You make a snowball, you keep rolling, the snow keeps getting bigger and bigger. I mean, it's the same principle with investing. I mean, that's really what you want to do. You want to try and do it so that, it's set. You do look at it from time to time, but you know, if you set it and you have a goal in mind, it should work for you. From there,
Vince, you muted yourself. Hold on one moment.
okay, sorry.
There we go.
Must hit someone I had was changing the slides. So the other one's diversification, right? You want to make sure that you're diversified between all the different asset classes, so that at any given point in time, you know, not every segment of the market necessarily goes up or down at the same time. So if you look at this chart, this is a 10-year window of most of the major asset classes, meaning large companies, small companies, international companies, cash, bonds, all the different aspects of the market that you can buy, right? So you can see that in general, they fluctuate quite a bit. Sometimes they're at the top of the chart, sometimes they're at the bottom of the chart. You know, the international one's the best one to look at because you can see the purple boxes really do bounce all over the place. You have some real good positive years and you have some real bad negative years. So what you want to do based on your time frame and based on your risk tolerance, you want to have a combination of all of these. So if I get you to focus just for a second on the white boxes in the middle, basically what you're seeing there is that is a combination of all the other asset classes. So you'll notice that those white boxes pretty much ride in the middle of that chart. They don't fluctuate quite as much as some of the other individual areas do. It certainly does not guarantee you a positive return, as you can see in 2015 or 2018, but certainly it's going to perform better than the individual security boxes that you're looking at, right? So, you know, if you look at 2018, you lost 6%, but if you had been in majority in the international market, you're down 13, almost 14%. So the whole idea is to smooth the ride, take some of the volatility out of your investments, and hopefully give you a smooth ride with a nice return. All right, it's really critical. And then the other thing you want to do on a regular basis as well, regardless of the portfolio and how it's structured, is you want to rebalance. So very simple math, if you had half your portfolio in stocks and half your portfolio in bonds, at the end of the year, it's no longer going to be 50-50. It's going to be some combination of 55-45 or something else. So you want to rebalance back to that 50-50 scenario. You really, it sounds, a lot of people have trouble with this, but you want to sell your winners and buy some of the losers, because usually last year's losers end up being the following year's winners. So you definitely want to make sure you're balancing your portfolio to achieve your objectives on a longer term basis. This is the key for the different colors. I mean, I'm not going to spend a lot of time on this, but you know, people hear terms like the Russell 1000 or the Russell 2500 or an EFA index. These are all the different indexes they use to measure different asset classes, right? So you have Bloomberg's a big one in the bond index. You'll see them, and JP Morgan. Then number 6, you'll see MSCI. That's the Morgan Stanley Consolidated Index for the Europe, Asia, and Far East. So all of these represent different areas of the market that you can be invested in. And you'll hear a lot about index investing in general. When you hear that, these are the types of things that people are investing in. All right, so where do we go from here, right? So that's all done. So how do you really get your hands around some of your emotions and try and keep yourself calm? And I always joke here because I'm in a 10-story building, but I can't open my windows, so when the market collapses, I can't kill myself. But I could spend an entire half a day on this chart alone. Basically, you can see from the pie chart, if you will, that people think it's 3 times the pain of a loss as it is for a gain. So they feel that much more than you do when the market goes up, right? And there's a lot of reasons for that, right? I mean, you see all those terms on the right. You know, what are you familiar with? So you can make some mistakes with that. Anchoring, like you have anchored yourself to some something you heard. You know, you oversimplify what the outcome is going to be. So you really think, you know, I'm definitely going to make money in this one. It can't miss, whatever. Hindsight, obviously, we've all made some good and bad investments, hopefully, in our lives, more good ones than bad ones. So we can look back, and sometimes that can hurt us as well. The endowment effect is kind of interesting. That's one of those ones where you think something's worth more than it really is, basically because you own it. It's kind of interesting twist. So I own this, so I think it's worth more, even though out in the marketplace it's worth a whole lot less, right? We all kind of think that about our own self-worth on some occasion, right? We think we're always worth more than we really are when raise time comes around. I'll put it that way. Status quo, sticking with what you know, bandwagon effect. Obviously, that's the herd mentality, group thing. Everybody thinks this is great, so I'm going to jump in and you know, Mike, you made a comment right at the very beginning. Once everybody's talking about it, you probably missed it. You know, the whole idea is to try and to get in before everybody's talking about it, right? So we talk about these video meetings and all the companies that are doing video stuff, or telemedicine's another area. So there's a lot of people that think these were the areas, but you know, they've already started to take off. Now, it doesn't mean there isn't still room to make some money in those areas, but people jump on that bandwagon. I have two more charts. I wanted to spend probably a lot of time on those, maybe not a lot, but a fair amount of time. You know, we talk about climbing a wall of worry. So this chart is your wall of worry. You can see this one only goes back to 2008. I could do this all the way back to 1929. You know, and depending on, you know, where you fall in terms of what you think's going on in the world or not. These are all the things that have happened over the last 20 years, right? So the chart starts basically around 2008. And this is not a political statement, but, you know, some people thought Obama was the end of the world, right? So he took office and the market started climbing. And then I'll go to the other side in 2016 and 2017. And it's in the blue. It's a little tough to see, but Trump won and people thought that was going to be the end of the world, and the market keeps climbing. And as you look at other items, you know, you got Hurricane Sandy, you got the Boston Marathon bombing, you know, the Paris terror attacks, OPEC axes, you know, their oil cuts. I mean, the list goes on and on, right? I mean, there's so many areas, and every time it's different, right? It's not going to recover. We're never going to be the same. It's pretty interesting how people look at things when they look at these charts. And again, you can take this all the way back to 1929 and see all the other issues, right? You know, you had the stock market collapse, you had the various world wars and all the Korean conflict, Vietnam. I mean, the list goes on, right? And all of these things had adverse effects on the market, but the market always manages to recover. And the famous line in our business is past performance is no guarantee of future returns, and it's not. But the history tells me from looking at these various charts that the market manages to rebound. We live in a pretty awesome country, and you know, and I believe we'll recover from our current situation that we're in right now. One thing to point out as well is if you'll see on the left, if you made a $10,000 investment in 2008, it's worth 28 grand today, and that's considering when you made that investment at $10,000, it dropped to 5 grand on March 9th. Of 2009, and yet still you got 185% return on your money if you hung in there. And if you happen to be lucky enough to put your money to work somewhere around March of 2009, which is what Bill Miller was talking about being such a great buying opportunity, when markets take big collapses, you know, it's hard to swallow and make that investment. But in a lot of cases, you know, I can't guarantee it, but I can tell you, I think in 5 or 10 years, you're going to have a lot more than you had when you made that initial investment. And just to do the math from the March low to that 28,000, that was 185% return. So even though you may not have gotten the 359 by investing on March 9th, you still would have gotten a 185% return if you had invested just before the collapse. So those are always good things to think of. So, you know, when you look at what's going on, I have one more chart that I throw at you because, you know, we have the pandemic right now. So what does that tell us? Well, here's a chart of all the various health concerns going back to 1980. And, again, you can pick any one you want. You go all the way back to 1980 and you see AIDS in there, right? That was huge back at the time. And I know right now they're trying to compare things a lot to the swine flu, and you can see that back in April of 09. So not only did we have a market collapse in March of 09, you had the swine flu as well, which didn't help things any in April of 2009. And what do you see there? The market just keeps climbing that wall of worry. So, here's all the various things that have happened over the last, 40 years, and the market continues to go up. So once again, my thing in staying calm is to look at history. We know in general history repeats itself. So let's hope that this is another case for history to repeat itself as well. And one of the other things I can throw at you is, obviously in March, the market was down a whole lot more than it is today. The Dow Jones is only down about 15% at the moment. It's probably even a little less than that because it's been up the last 2 days. But that's still a buying opportunity at 15% down. And the S&P is still down, I think, about 10. So there's still some opportunities in a diversified portfolio to make some money. So I certainly would encourage everybody to take a look at their holdings, or have your advisor take a look at your holdings and see if there isn't something else that you might want to do. So I leave you with something I saw in the paper literally yesterday, and I'll read it. It says, if you were fortunate enough to be employed during this time, it's time to ask yourself the question, if I wasn't picked to stay employed, what would my personal financial situation be? If you're not sure of the answer, or if you don't like your answer, then you need to work on plans B or maybe plan C's. So understand the markets, understand that there's volatility, look at the long term, keep invested, compound interest, dividends, and capital gains, diversify, review on a semi-annual or annual basis, and I think in general, you'll come out okay. And with that, I thank everybody for their time. I wanted to keep it quick. I didn't want it to be a real long thing, but if anybody has any questions, I'm happy to take them at this point.
Thanks very much, Vince, for the presentation. You hear me all right?
Yes.
Yeah, I hear you, Bill.
So the question I put in the chat was, as someone who's always invested in index funds and then index ETFs, a lot of the talking heads on TV are saying now that it's a huge mistake not to go into individual stocks right now and to stick with vanilla discipline but index fund approach. Is that a self-serving comment, or is it valid to rethink investing strategy from index investing to individual stocks?
Well, first off, I don't think there's anything wrong with index investing. It's fine. But what's happened recently, if you really look at the markets, right, and everybody can make their own conclusions on what the pandemic's had in terms of the varied asset classes, I would argue that it would make sense to have some dollars in not necessarily individual stocks, but different sectors of the economy right now, right? So if you look at, I'll give one that I'm sure everybody will realize is hurting dramatically at the moment. That's the airline industry, right? So, you could look at that one of two ways. You could look at that as a great buying opportunity because you think it's going to rebound at some point in the future, or you can look at it from the standpoint, you know what, I don't know if they'll ever recover and I'm not touching it. So, it runs the gamut both ways, but there's certainly, again, I mentioned the whole video world is where we're going in the future. I don't want to name any particular stocks because I'm not supposed to, but that's an area you might want to look at. Telemedicine is another area. I mean, I don't think, my wife happens to be an APN in mental health, and they haven't seen a live patient in, I don't know, I guess it's pushing 2 months now. Will that ever come back? Yeah, I'm sure some of it will, but a lot of people are going to be very comfortable, seeing their dentist via Zoom or whatever video chatting you may have. So I think what makes sense is to have your foundation, if you will, just like if you're building a house and, you want that nice sunroom. So that's going to be some piece of investing that I think might be good to jump into, some area You know, as I mentioned, I work for Motorola, Lucent, and Sony, so I'm a tech guy in terms of believing that's always the future. So I think there's nothing wrong maybe picking a tech ETF to invest in and you know, get the benefit of that. You look at an Amazon, right, and what they're doing to the world. Just to show how old I am, I had a cell phone in my car in 1982 because I worked for Motorola. So, you know, and I remember saying, nobody will ever have a phone until they bring the price down, which they finally did, right? So now everybody carries a phone around, and that PC and that GPS and that digital camera all on your hip. It's pretty crazy, right? They were all separate devices when I worked at Sony. So yeah, I think there's an opportunity to pick and choose sectors that you think might be good areas to invest in. But don't totally disregard the index. That's your foundation. Leave it there.
Okay, I have a question from Jay. Jay, do you want me to unmute you? All right, there we go. Try again. Wait.
Okay,
There we go.
how's that? I think
Perfect.
I had
I got
myself.
you, Jay.
Hey, how are you, Vince? That was great stuff, by the way. Thank you very much for presenting all of that.
Well,
So, you know, as you know, and I think probably everybody on this call knows, I do a lot of work with sort of, you know, community impact and things like that, and having a lot of conversations. I actually hosted a few webinars myself on this idea of impact investing, where investors want to align sort of their investments with some social objectives, you know, maybe not investing in tobacco companies or investing in companies that are women owned and led and things like that. So do you hear about that much from your clients, and do you incorporate that in some of your strategies, or what would you say to folks that wanted to do that type of thing?
you know, I have looked at some of the, what I'll call socially conscious funds, if you will, you know, the ones that are playing in those kind of areas that you're talking about that don't want the alcohol and the marijuana and regular cigarettes and those other things.
Yeah.
So yeah, there's a couple of funds out there that play in that space. You know, I will tell you in general, it's sex, drugs, and rock and roll are what, you know, sells versus some of those other ones. But there's definitely a lot of interest in those areas. I know there was a couple of women-owned ETFs out there for a while. I'm not sure if they're still there, meaning companies owned by women or run by women. But yeah, that's, you know, I know a few of them. I don't know a lot of them. And, you know, I don't get a lot of requests for that. What I get more of, and I know you're in this world, is the, you know, how can I leave my money to, you know, some sort of nonprofit or some charity? You know, you get that question with your donor advised funds or an area you can use in that particular space as well if somebody's looking to give money away.
Okay, good. Thank you.
All right, thank you. Any other questions? No, I don't see any raised hands. Okay, Vince, do you have any other?
I have one
there we
question,
go.
Colette, for Vince.
Yeah, Mike.
So, do you see now that there, you know, it looks like there was apparently some kind of a bottom, and I know it's kind of silly to try to call bottoms, but it's clear that there's been a rebound. Do you feel that this is going to go, and I know you don't have a crystal ball, but do you see another downturn in the near future that we should be prepared for?
You're right. It's tough to say because my crystal ball is no clearer than anybody else's.
Yeah.
I do believe, based on my own experiences, what I'm hearing from economists, that yeah, we've probably hit a bottom, and I will put like an asterisk on that. I mean, it really just depends on whether we have a recurrence in the fall and winter of the virus and things get bad again. Plus, you won't. This is one man's opinion. Now, I don't know if you're going to get a good feel until at least this September timeframe. You know, we're in the middle of this, well, not in the middle, but we're getting started in the summer. You know, you got to see about schools getting back, people getting back. You know, I don't see the V-shaped recovery that some people talk about. I think it's going to take a little longer than that. But as long, again, but you know, as long as there's enough time, and again, it just depends on your age and how much time you have, as you saw from the one chart, it's still a great time. The market's down, and most analysts do not think it's overvalued. So that means there's good buys out there right now. So I don't see a recurrence unless something changes, right? And that's really the only way I can determine. That could be anything besides a pandemic, right? I mean, we're getting into this battle now, it looks like, with China again. So, I mean, that could cause ripples in the markets, both here and abroad. So, it'll be interesting to see. I make statements, people talk about getting things out of China. Well, if you bring them back here, there's a cost to that, right? I mean, we're not going to be able to produce it at the same levels that they produce it there. Or then you talk about they're moving it to Thailand and Vietnam and these other countries. Well, at some point in the future, are we just going to end up in the same boat? So it'll be interesting to see how some of that international stuff plays out. But yeah, I don't see anything dramatic unless the COVID rears its ugly head again, really.
Yeah, they say it may come back in the fall, and that would coincide with the election. So it could be some volatility there.
Well, the other thing you got to look at too is what is Christmas going to look like, right? I mean, there's 30 million people out of work today. Obviously, some portion of those folks will get back to work, but I think we're all smart enough to know that if restaurants can only do 50% of their seating or whatever, that they're not gonna hire back as many people. I mean, they're just not. And then can they even survive on 50% capacity? So there's just so many question marks out there right now. And then, and I'm not taking sides, but I think just in general, our elected officials in Washington could be doing a little better job across the board, to try and make things work a little better. I'll just leave it at that. It's not a political statement. It just is what it is.
Yeah.
But yeah, I mean, Christmas will be big as well, depending on how much money people have, right? Or even people that go back to work, right? If they've been out of work for a couple of months, or maybe they couldn't get the PPP or the stimulus money or anything else that's going on, they might be in a tough spot. So, I think between now and the end of the year is going to tell you a lot. That's all I can say.
Okay. Thanks, Mike.
Invest in the chamber.
Yes, invest in the chamber.
Hey,
We'd
you know
appreciate
what? And if you want, I'll give you a plug there too. Like I said, I've been in the chamber 17 years, and it's been good for my business. It's been good for me personally. There's some great people on this call, like Bill Alderman and Nicole Barone and Debbie Wopal. I mean, friends of mine, and it's become way more than a place to get business, and I get business here. But it's been a great opportunity to meet a lot of great people. Jay, I'm looking at everybody now, so I don't forget anybody. Wendy, I mean, these are all awesome people I've gotten to know that have become friends, as well as some of them being clients. So it's all good. It's all good, man.